Every empire claims its currency is secure. Every government insists its financial promises will endure. Yet history proves again and again that none of these assurances last. From ancient Rome to revolutionary France, from the Confederacy to modern Lebanon, countless people have awakened to find their life savings destroyed, their paychecks worthless, and their futures erased by systems they believed were stable. Collapse isn't rare, it's normal. The real question isn't if financial systems break, but how you protect yourself when they do. The greatest danger is believing money is permanent. We look at our bank balances and national currencies as if they're carved in stone, but money isn't stone, it's trust. And trust can vanish in a single night. History leaves behind clues, patterns, warnings, and hard-earned lessons about what truly preserves wealth and what disappears. Survivors of financial disasters were never the ones who trusted most, they were the ones who questioned early. Take the Byzantine Empire, often remembered as Rome's eastern successor that endured 1,000 years. At the center of its economy was the gold solidus, a coin so consistent and pure that merchants across Europe, Asia, and the Middle East accepted it without hesitation. For centuries, it functioned like a global reserve currency. Yet even the Byzantines repeated Rome's mistake. Just as Roman emperors destroyed the silver denarius by diluting it, Byzantine rulers began quietly reducing the purity of their gold coinage. At first, few noticed, but eventually trust cracked, and the once reliable solidus became just another political illusion. When faith in the currency collapsed, so did economic stability. Those who protected themselves weren't holding government promises, they held actual gold or land the state couldn't tamper with. That's the first timeless truth. Governments almost always give in to the temptation to water down their money, and when they do, wealth escapes into anything they can't counterfeit. But empires don't only fail through mismanagement. Sometimes disaster arrives suddenly, like in the 14th century when the Black Death swept through Europe and killed as much as half the population. Towns emptied, farms were abandoned, trade collapsed, but an unexpected economic shift occurred. With so many workers gone, labor became valuable. Survivors could demand higher wages. Land and homes became cheap because people, not land, were scarce. Something similar happened during the COVID-19 pandemic. Supply chains shattered, governments printed trillions, and those with cash bought assets, while living paycheck to paycheck struggled. Housing prices surged, stocks rebounded rapidly, and inequality widened. The pattern is universal. Pandemics reshuffle wealth. They always have. Another lesson comes from 14th century Florence, then Europe's financial hub. Its celebrated banking families loaned huge sums to kings, especially England's Edward III. When he refused to repay, Florence's mighty banks collapsed almost instantly. Ordinary people learned the hard way that an institution's size and reputation offer no guarantee of safety. Too big to fail has been alive for centuries, from medieval bankers to Lehman Brothers in 2008 to Lebanese banks freezing accounts in 2019. A similar story unfolded during the American Civil War. Both the Union and the Confederacy printed money to fund the war, but the South printed so aggressively that its currency eventually became worthless. Prices rose thousands of percent, and salaries couldn't buy even basic food. What held value wasn't paper money, it was tangible resources: land, food, gold, goods. The United States has already lived through a full currency collapse. People just forget. Revolutionary France repeated the cycle in the 1790s. The government created a new paper currency called the assignat, supposedly backed by confiscated church property, but they printed it endlessly. Prices exploded, wages lagged behind, and the currency became useless. Farmers refused to accept paper money and demanded silver or goods instead. Bread riots erupted. Again, the winners were those holding real assets, not government promises. Fast forward to Asia in 1997. Thailand had borrowed heavily in US dollars, trusting its currency peg would hold. When that peg broke, debts became impossible to repay, and a financial earthquake swept through Southeast Asia. Currencies collapsed, unemployment soared, and economies shrank. Ordinary families suffered most, their savings evaporated overnight. Those who held dollars or foreign assets weathered the storm far better. The deeper lesson: debt denominated in someone else's currency becomes a trap the moment crisis hits. Across eras and continents, the same themes appear. Paper currencies collapse, debt destroys households and nations, institutions fail suddenly, and those who survive are never the ones who believed the system was unbreakable. They're the ones who recognized its fragility before everyone else. These warnings aren't ancient relics, they're alive today. Between 2019 and 2021, Lebanese banks suddenly froze customer deposits. The currency crashed by over 90%, life savings turned into scraps of paper. People begged outside bank doors for their own money, money that effectively no longer existed. Those who had diversified abroad, held gold, owned property, or kept cash outside the banking system suffered far less. Americans witnessed versions of this too. In 2008, millions lost homes and retirement savings while the banks responsible for the crisis were rescued. During the 2020 pandemic, trillions were printed to keep the system functioning, inflating asset values for the wealthy while ordinary wages stagnated. In 2023, several regional U.S. banks collapsed almost overnight, reminding the world that too big to fail is comforting fiction. So what actually protects you? There is no single universal solution. In Byzantium, it was gold. After the Black Death, it was having liquidity to buy land. In Florence, it was skepticism towards powerful banks. In the Confederacy, it was tangible goods. In France, it was food and property. In Asia, it was avoiding foreign currency debt. In Lebanon, it was getting out of the banks early. The specifics change, but one principle remains constant. True security comes from owning what holds real value when illusions collapse. Here lies the paradox. Collapse is both devastation and opportunity. Those unprepared are ruined. Those with resilience, liquidity, and uninflatable assets acquire wealth at a fraction of its old cost. After the Black Death, peasants became landowners. After 2008, people with cash bought homes at steep discounts. But wealth is not only about possessions, it is also about ability. The people who rose during crises weren't just those holding gold. They were the ones who could produce value when others couldn't. The baker who still had bread, the craftsman who could fix tools, the farmer who could feed a village, the merchant who could move goods. Production remains valuable even when money collapses. Humans still need food, shelter, tools, services, and trade. Those who provide essential value rarely stay poor. That is deeper protection. Not blind faith in institutions, but a combination of real skills, real assets, and awareness that systems built on trust can unravel at any moment. Every crisis transfers wealth, from the many who believed to the few who prepared, from paper promises to tangible value, from passive savers to active builders. History repeats the same pattern endlessly. So the real question is not whether collapse comes. It always does. The real question is this: will you be left holding empty promises, or will you be among the few holding something real?